overall, we see those numbers come out, and the marketplace still does not seem to be too impacted. What are your thoughts about the overall market right now?
Well, it's really interesting. And you bring up a great point, Kevin. The data coming out worse than expected, better than expected. It's been kind of all over the road. But one of the things and the expectations I think the active investor has taken to the marketplace is that we braced for the worst. March 23rd, when we saw the S&P 500 under 2,200, look how nasty that candle is back on March 23rd. I think a lot of the pricing or the price discovery mode that the S&P 500 was in was all intending the worst case scenario. We've seen vaccine hope. We've seen stimulus. This morning, the ECB, Christine Lagarde, came out with an additional 600 billion euros of asset purchases. That put a little bit of wind in the sails. So to your point, I think the question you're really trying to hit on with the S&P 500 trading at 3101, is that justified? And that's what a lot of traders are asking. Can we justify what Q2 earnings are going to look like, the data, and all of that justifying the move in the market? And I don't have to sit here and try and explain if it's justified or not. What I do have to point out to the fact that technically this is the price, and this is the price we're establishing. Are we a little bit over our skis? Potentially. Yes, I think some of the Q2 earnings as we try to reopen, it's going to be ebbs and flows. But I think the stock market, in the same way it was exaggerated, and the momentum took us to the downside of that 2172, the S&P 500 level on March 23rd. It's the same technical target. We talked 2 weeks ago when we had our conversation how 3150 was a target for us at KKM Financial. Why 3150? Well, we utilized a little bit of our secret sauce, but it was getting above that 2-day moving average and seeing a lot of short positions. And the biggest risk in the market, Kevin, which we've talked about quite some time, either on your show or on CNBC, is the underinvested. The folks who are sitting in cash, the folks who may have missed to put some money to allocation. That's been the biggest risk, and that's why the market continues to move higher, because markets like to inflict the most amount of pain to the most amount of people when possible.
Definitely, and you are hitting it on the head there. And what's really actually interesting, Jeff, the 3,000 level was actually where I was. I had that as our milestone, right? We always like to look at it when we come to traders, and we look at the whole numbers. We look at the 3,000 level, 3,020, 3,250, 3,500, and so on. We like to look at those price increments. And what's really interesting is we surpassed the 3,000 level here, and I'll actually bring up our chart and try to expand it here. I thought it was very interesting. We see that we've surpassed the 3,000 level about maybe 4 days ago, 4 or 5 trading days ago. And we are continuing to reaffirm that the 3,000 could now be a support level. And it looks like the market is actually trying to make that case. You know, we would typically see maybe a range between this 3,000 level, 3,100 level. But it looks like from this trajectory, now there's still some time left, right? We still have some time. But it just seems like from this trajectory, I'm very interested that the market didn't see an immediate pullback to the downside after breaking 3,000. So do you think that the 3,000 level may be an area of support, or are you giving yourself a little bit more wiggle room on the downside when it comes to looking at the overall SPX?
Well, I think it's a great point you bring up. And whenever we talk about a back and fill opportunity, and that's that old level, that 3,000 level, that's where we fell from. So whenever you see gaps in the marketplace, you typically like to see a back and fill. And back and fill simply means that we will see the price of that underlying futures contract go back and consolidate into those gaps. But what's interesting is that when we had that snapback, the reversal of the market on March 23rd, and that was a bad down day. The S&P was down about 9%. There was true panic in the tape. And that was actually the day that Fed Chairman Powell came out and said, we are committed in perpetuity in an unlimited capacity. Took a little bit of time for the market to digest that on that Monday of March 23rd, but we turned around and we went right to 2680, which is a Fibonacci level. So we did see some technical components come into the play. Once we got to 2680, we never looked back. And everyone in between those 5-6 trading sessions, how we went from 2172 to 2680, a lot of people, a lot of pundits on TV are talking about retesting the lows, retesting the lows. We haven't really heard anyone talk about retesting the lows as we're trading 3100 right now, but I think it's a very technical trade. So for you to bring up the fact that that old support, that old resistance is going to be support, I think it's important to rely on the technicals. We run a lot of model portfolios powered by NASDAQ Dorsey, right, which is all quantitative, all technical. So I think sometimes if you use technicals, if you're using Fibonacci, I think it's imperative to lean upon these technicals in times of market distress, in times of excess noise or turbulence in the market. The technicals give a little bit clearer picture.
Yeah, I agree. And I was actually talking to a really experienced floor trader earlier today, and we were actually just having this conversation. And maybe we could chime in on this, but
I
it really
spent a
does
couple of
seem
years.
like
I spent a couple of years on the floor, but yes.
that's where I learned. I learned from all the old floor traders that were out there. You guys
Kevin, I'm not that
are
old.
a
I'm
really
only
good trade.
45. Don't beat me up, man. Don't beat me up.
Not too much. But what I thought was very interesting is we were talking about earlier today the fundamentals and how the market really looks like it's shaking off the fundamentals. And as you said earlier, the market is really forward looking, and maybe the market is actually pricing in 6 months and maybe even 8 to 12 months down the road. And they're looking ahead to say, okay, we're going to have the vaccine. The shutdown was on purpose, right? So it wasn't anything that was truly systemic within the
Systematic.
marketplace.
Systemic, yes.
Right. And then now we're going to be able to open up. So we are going to continue to buy because from the fundamental standpoint, it seems like, yeah, you would want to be able to see a little bit of a pullback because just the numbers aren't adding up compared to where the market is going. But I like what you said. The technicals could also assist you, and it's more of a supplement, right? Or
That's right.
we can't just trade off of one thing. And can you kind of just explain how you all do that at your firm as far as trying to navigate the overall marketplace and when one thing doesn't really add up or doesn't give you a clear picture like fundamentals at this point in time, how you can leverage some of the other aspects of trading to help out your trading decisions.
I think that's been the biggest challenge, and you really bring up a great point. If it's an asset manager like KKM, or if it's an active trader, or if it's even a Federal Reserve chairman like Jerome Powell, the way to measure engage this pandemic, we don't have the measurement tools. We don't have the actual devices to understand. You even saw that evidence today when the ECB head Christine Lagarde came out and said, we don't really know what the GDP slowdown, we're projecting, we're forecasting that's going to be a minus 9% move lower in GDP, but they really don't know. So that's where we like to incorporate technicals to help us better understand. We have conviction. One of our portfolios is called the Essential 40. We believe these 40 names are critical to the U.S. economy. So these are all blue chip names, you know. But you do have inside of those names, we do have an American Airlines, right? That's an essential name. It's up 40% today. We'll talk about that later. But there's also some opportunities inside of the sectors you have exposure to understand, because this is a really dislocated rally. So if you can apply or overlay the technicals, you can get a better understanding. And we use technicals. We actually sold out of banks in our model
Mm.
on March 25th. We bought the biotech sector. Why do we do that? Well, the technicals told us that banks fell out of favor. So it's imperative to respect. Maybe you don't trade off the technicals. We do. But I think it's important to respect the technicals when you maybe have an overexposure or an overweight to a certain singular stock, ETF, or sector, Kevin.
Definitely. It's great that you're able to utilize those different aspects when it comes to overall trading and to be able to build a portfolio. And I think that's a really good insight to some of our retail traders that we have here at Schwab as well. Because sometimes the retail trader says, I don't have all of the mechanisms in place. Well, if we take it from a bigger asset manager, they're doing the same fundamentals. They're looking at the technicals, they're looking at the balance sheets and things of that nature to be able to come up with some form of a model or a trading strategy. So it's always nice to be able to look under the hood a little bit and see just how that actually works at some of the bigger firms.
Yeah,
Now,
and
Jeff,
Kevin,
what I
I think a
yeah,
lot of those active investors, can look at if it's RSI. You can. There's so many tools on the Street Smart Edge. You can look at RSI. You can look at Fibonacci. Look at 50-day moving average, 200-day moving averages, 10-day moving average. But I think you guys do such a great job in education. I think you have to expose yourself, at least get a basic understanding of what these technical tools are available to you. Because when you see volatility, and certainly volatility is coming in the last couple of trading sessions, as we did cross and vault over 3,000, the S&P 500. But when volatility is, and the VIX specifically is above 50 or above 80, it's really hard to get a basic understanding of what type of rebalancing, what type of navigation you should be doing in your portfolio. And that's where the technicals, whatever technical measurement that you may want to lean upon, get comfortable with one or two and incorporate them. Use them as additive. They're just additional arrows in your quivers that's going to help you when you see heightened volatility, Kev.
I definitely agree with you, and thank you for the compliments regarding our education. What I want to also bring up here is the Dow, and the Dow is a little bit different from, let's say, the SPX and the Nasdaq, which we'll bring up, and we'll look at the Nasdaq 100s as well because we do have a new milestone today. Uh, Dow right now down about 0.6%. Now, Jeff, from a Dow component standpoint, do you think that as we continue to see this sector rotation, because I think we've seen a little bit of a sector rotation last 4 or 5 trading days on the upside, but we have seen a little bit of a rotation. Do you fear that the Dow may be a little bit more of a laggard compared to maybe the Nasdaq and the SPX when it comes to gains moving forward?
So you got to go back to 1896 when the Dow was created. The whole idea of the Dow was to be an accurate representation of the U.S. economy. So these are 30 blue chip names, and you're seeing a day like today. This is the actual conversation we've been having on CNBC lately. This is the catch-up trade, Kevin. The catch-up trade are these industrial names, these laggards. Some of the blue chip names have just been absolutely bearing the brunt of the COVID-19 environment. So look at a name like Boeing, which obviously is a big representative inside of the Dow Jones, and Boeing's up, nearly 6% today. So you're going to see, ebbs and flows in and out of these names. But I think the rebalancing you're talking about, I think that's so critical. And if you've had overweight exposure to technology, it's been a very profitable and winning approach. And you're seeing the NASDAQ, despite the fact that it hit an all-time high today earlier, you are seeing people rotate out of some of these high-flying FANG stocks, and you are seeing come in to some of these. We actually have a portfolio called the Essential 40. We believe it's our modern-day version of the Dow Jones, but it's 40 blue-chip names. But there's names in the Dow Jones as well as the Essential 40. These are kind of boring names, right, Kevin? But the
Hmm.
Bristol Myers, the Berkshire Hathaway, the 3M, the FedEx, the General Motors, Dow, Costco, Intel, Boeing, Chubb, some of these names that just haven't gotten the love or attracted assets in the way that you have seen the Microsoft, the Apples, or the Amazon, even some of the post-COVID names like Zoom, which have really attracted assets. But we go back to, I think it's important right now to understand what you own, but a name like Boeing, it's recovered dramatically, right? I mean, it's still down on the year. It's nowhere near its all-time high, but it's up from where it was in the low 90s to up over 182 right now. And I think this is a name that's going to continue to recover as we get more and more, glimmers of hope of the business travel and leisure travel reopening in the month of June and July. And I think this is, lock and step with the airlines, which have absolutely been abused.
Yeah, I agree with you. And what's actually very interesting with Boeing is, like every company, but Boeing has had some issues, obviously pre-COVID. They had the 737 MAX issue, which they now sounds like they're going to be able to put that back into production here soon. But they also had some other issues out there, right, Jeff? They also had some debt issues that were out there. They were trying to raise capital in a time where it was really hard to get capital for about maybe a month and a half. And it's really interesting to see Boeing come back the way it has. I mean, to drop down below the $100 level, mid March area, and to be able to come back to about $182. I mean, that's still an enormous move. I mean, you're talking about an 80% move to the upside from its lows there. And what's interesting now is as the economy continues to grow and open up, right? We're starting to see some of the smaller suppliers are starting to produce again, and it seems like the engines are starting to turn back on. Where I think right now their biggest headwind. I mean, this left some issues, but I think their biggest headwind that they were concerned about reopening is their supply chain, and it seems like the supply chain is starting to get back on board. So I mean, there's potential here for Boeing, but it's just it's an amazing I would call it even a comeback story because it was not looking too good for them for a little bit there. Maybe you agree, maybe you don't,
Yeah, and I
but
think
it
that was priced in the option market when you saw it trading
yeah.
under 100. That implied volatility. If you're a put seller around that 100 strike, you were rewarded handsomely. And I think you had to really assess what your risk appetite was at that level. To your point, as we're nearly 100% higher off of that 92 low, Boeing is still has to go up another 100% to recover where it was in fall of October of
Right.
19 when it was trading 375. So this
Mhm.
company has had a really rough road, but this is a holding that I've had personally for a long time. We've written a lot of options on it, selling calls, buying puts, selling puts down low. So it's been a really tough slog, but I believe that the company will get back to where it was. It's just interesting. How do we measure this, Kevin? Is it
Mhm.
the same format that we're going to utilize post 9/11 when there was a true fear to fly, and rightfully so, from the terrorist attack? Or is this more of we had to press pause, we have to see people get more comfortable with getting on planes because post 9/11 it took 2 to 3 years for airline travel to resume. I don't know if it takes that long right now, but again, this is going to be tied and tethered to a real vaccine and the ability of that vaccine to be distributed amongst the world, not just domestically.
Yeah, and also from a retail standpoint, it's going to be the airliners themselves. So the American Airlines, United Airlines, are
Yeah,
they
let's
able to
pull up
get
that
that?
chart, Kevin. Pull American
Yeah,
now.
let's
This
do
is
it.
this is unbelievable. Here's a. It's still down 50% year to date, but it is having a day of all days. And I know you had some news you wanted to kind of let folks know, but it's up 38% today. 38%. Shorts are being absolutely smoked in this, and they're seeing a lot of stops being executed, seeing a lot of people cover. But shorts have made a lot of money in this stock, so I'm not going to feel sorry for them today.
I completely agree. I mean, to say that the IV right now is at 155 is a it's amazing to see this overall
You
news. So
just like
yes,
refresh your screen, right? Is that real?
yeah, yeah, no, yeah, and I mean, to even see, we can actually look at some of the options chains here as well to see what the IVs are. But American Airlines, they did announce today that they do plan on actually expanding. So they did contract their summertime travel schedules, but they plan on expanding it because they are seeing some demand when it comes to ticket purchases. And Jeff, just for my own, and maybe some of our attendees can vouch for this as well, but I was actually looking at tickets right when we were hitting the lows, right? That was the first thing I was doing. I was like, man, it's
Absolutely.
COVID's bad, but I could get a trip very, very cheap right now. And I was looking actually at ticket prices through it. I was actually looking at Southwest Airlines. We could pull them up as well. And they had tickets going for $45. I haven't seen that price to go from Denver to Chicago in a long time. The prices have already doubled for the same tickets. I mean, so you are actually probably seeing a little bit of demand here. So obviously that's going to be a really big boost for the airliners. American Airlines definitely doing a really good job today. Let's pull up Southwest. Now, Southwest is actually interesting. It's up 4%. Now, when we talk about American Airlines, Jeff, actually, let me go back really quick. When we talk about American Airlines, is there a fear of potential travel bans to other uh, international travel bans that could jeopardize the stock? Or do you think that was really just talk to try to get China to the table? What do you think?
Hard to ultimately measure, but I think we have to consider all potential travel bans. That's going to be more amplified if we do see a second wave of COVID-19 this fall, November, December. But I think there's been such a headwind pushed on the American Airlines, United as well. So I think the space itself, I think you're going to see some form of consolidation. And if that's the lower cost, if it's Spirit or some of the other airlines, maybe there's some consolidation there, like we've seen previous consolidation in the wake of the great financial crisis. I think we just have to understand that the volatility is not going away in the stock. And yes, they are having a great day today, but still year to date, it's down 50%. So this has been a tough holding of ours. We do believe in the company. I fly American. I used to fly American when I fly, but I think demand will pick up, and it
Hmm.
seems like there's more optimism, Kevin. Every week, and the airlines are participating in that optimism. So there's definitely a correlation there. We will see how things open up in the month of July, not just from a business flight perspective, but from more a leisure perspective. But you have to be mindful of the fact that a lot of folks are not returning to the offices. A lot of these conferences, these industry conferences, pick your industry. If you're a pharmaceutical salesperson or if you're in the financial industry, a lot of these conferences, they're just not happening. So a lot of
Hmm.
that business travel is just not going to come back in the year of 2020. But I do think there's opportunity in some of these names and love LUV. That's the Southwest airline you talked about. There's going to be some bifurcation and dislocation in between these bigger names, but I do think that we will see this space, specifically in the airlines as well as Boeing. I think you'll see that heal over the next quarter or two.
Yeah, and so it's amazing. If my memory serves me right, I was looking at just doing some research. I was looking at some July calls. I want to say it was the third or fourth, the third calls, but I was looking at some July calls on Southwest, the $30 calls about a month or 2 months ago, and they were trading at like 35 cents. And you're and you're seeing the market, obviously moving up even higher. So when you're looking at the the options in airlines, you're definitely going to see some of the implied volatility being priced in those options now as the market continues to open up. And Jared was actually asking, Jared from Hawaii, what is IV? So IV is implied volatility, and what we actually look at is uh, the implied move of the stock over time. And implied volatility is actually going to be an annualized number, but when you're seeing a number of high implied volatility relative to the past, that's just basically saying the market is anticipating this stock, for instance, the implied volatility for Southwest Airlines right now is at about 69. So it's pricing in this stock is either going to be 69% either higher or 69% lower. Now, it's not always going to be the case, but that's really what we're looking at for implied volatility. So as we see more trades, more anticipation, news events that come out, the implied volatility for the stock is going to increase.
Yeah, and I think
Uh,
it's just to add on to that, I think that's a great point to bring up. Implied volatility is simply the expectations, and the expectations are determined by the options market. So if you pull up the VIX to kind of do a quick segue here in implied volatility, the
yeah,
VIX, which is the CBOE's volatility index, that measures the volatility, the implied volatility, and all the VIX does, it's a simple calculation. It's taking the options of the S&P 500 and understanding what people are willing to pay for protection and the downside and what they want to buy on the upside. And that input sets the stage for what the next 30 days potentially be. So a VIX of 16 is suggesting that there's going to be a realized move, and a realized move is actually what the S&P 500 is doing on a daily basis. So right now the S&P 500 is down 79 basis points. So if that was to be measured in VIX, it'd be about a 14. Well, obviously, we're seeing the VIX much more elevated. It was up over 80 during the height of the month of March. But implied volatility and realized volatility, two different things. Realized volatility is what the actual market incurs on that day. Implied volatility is what the expectations are for an index, for a stock, for an ETF for the next 30 days. That's the typical measurement that we utilize to give us a better understanding if volatility is heightened or not. And that sets the stage for all the options traders. A lot of people love to sell options and collect premium. Well, if the volatility, the VIX is up higher, well, then the amount that people are willing to buy for downside protection, buying puts, that's going to be higher. So there's more premium to collect. So that's how it kind of slides back and forth with implied volatility and realized volatility.
perfect, perfect. Now, Jeff, we actually have some questions going in here, so we are
Quick
going to
101
dive.
then for you in Hawaii.
No, that's what we're here for, and it's really good to be able to see. We do have a couple of questions here for you, so we're gonna bring those up, and then we'll talk about some of the market news that is out there. So Joel from Texas wants to know. So Joel says, "Hi Jeff, you have been relatively bearish on financials. If the TNX continues to rise, would this change your stance? And is there an industry you like more than others?" So, one, if the yields continue to go up, are you still going to be bearish on financials? Are you going to change your mind? And then also, is there a one industry that's out there that you're saying, you know what, get into this one right now?
So that's a great question. I have been bearish on financials, and we still own JP Morgan, our Essential 40. We think that's the blue chip of the banks currently right now. But it's a challenging environment, and with the 10-year going up to 81 basis points, that still doesn't get banks profitable from a net interest margin perspective. And when we sold, we were with the banks for quite some time. When we sold the banks on March 25th, we bought biotech. And I think the biotech space, or let's just talk broader, XLV, look at the healthcare ETF. I think the global sense of urgency into healthcare, or specifically biotech, which we like to utilize IBB for that ETF exposure into biotech, I think that gets more exciting. And we run a model, the sector rotation model, and both of those holdings, IBB and healthcare, are both in there. And why are they in there? It's just because of the vaccines, because of COVID-19, it's because of this new economy. So we get more excited about some of those sectors versus the financials. Will the financials turn around? Yes, but we'll wait till technically they turn around on our systems, which are powered by NASDAQ, Dorsey, right? But until then, right now, financials, we are not touching them with the 10-foot pole, despite the fact they've had a nice little snapback here.
Yeah, definitely. And actually, a couple of big names that were out there were really actually trading at discount to book value. And I think it was really hard to actually assess what the actual book value was going to be because there was this big fear of credit risk, right? And the risk that's out there and the overall price
The
for fixed incomes to
exposure
do.
that had defaults. That's right.
Right,
That's right. And
right.
every bank has different exposure. Regional banks,
Mhm,
obviously, were punished a little bit more. We certainly saw the bigger banks with stronger balance sheets prevail. But then, like a Goldman Sachs, every bank makes money in a different manner. So we like
mhm.
J.P. Morgan. We love their fortress balance sheet. We believe that's an essential bank. I think the economy would be really challenging if JP Morgan Chase was to go under. So we have that confidence, that clad iron safety net by the government. But JP Morgan Chase is a bank that's going to find a way to make money. But the banks in this new normal, in this $16 trillion of negative yields globally with the 10-year at 81 basis points, they're still going to be in a challenging environment. And I don't know what that looks like in 6 months to a year. But the next 6 months, I think the banks they're going to recover to a certain extent, but I don't think they're going to have the ability to hit on all cylinders like we've seen tech and like we have seen some of these industrial laggards. That's another ETF that we like to have exposure to because some of these industrials have really lagged for quite some time.
Yeah, and it's going to be interesting too. I mean, it looks like from the equity standpoint, we're getting out of this quote unquote recession. I'm not sure if we can even call that be the quickest recession, probably on record. But it seems like we're getting out of that from the equity side. But you're right. When we're looking at some of these banking institutions, the regional banks are going to have a really, really tough time, especially when you're looking at some of the places like Texas, Oklahoma, even northern Colorado here, that's really focused on the energy side, oil and natural gas and things of that nature. A lot of those regional banks are the ones that are actually funding those operations. So we're going to
Now, you know
see
what's really
it.
interesting, Kevin, not to interrupt
Yep.
when you say energy.
Yeah.
So recently, our sector rotation, which has not touched energy for over literally 24 months, it's been staying away from it. We just saw a position on May 6th into the IGE, that's the North American Natural Resources. And we also bought energy on April 15th, IYE or XLE, contingent upon what ETF you want to utilize. But we have seen a technical turnaround in both energy and natural resources. And if you look at, the IGE, there's a lot of holdings in there. And I think it's important, whatever ETF you're in, I think it's really important to have a good understanding of what those holdings are. So
Hmm.
IGE, which is the iShares North American Natural Resources, that's ExxonMobil, Chevron, Conoco, but it also has Barrick Gold in there. It's got Newmont, Kinder Morgan. So it's a nice broad swath exposure. But both of those sectors have been highlighted on our systems, and we own them both now, and it's been rewarding. But it's interesting to see where no one wanted to touch energy in April. It still
Hmm.
felt like it was a falling knife. So that's where we go back to trusting the technicals, Kev.
Yeah, I mean, yeah, where you see crude oil. One thing I wasn't going to bring up, and we'll bring up a crude oil chart, but you were talking about actually seeing some of the holdings. So if you actually go to the launch tools and you click on the research tab here, it's a little book, it'll bring up this tab. And for the ETFs, you can actually click on the portfolios tab here on the right hand side, and you can see the top holdings and their asset weightings as well. And like you said, Jeff, it's really important for you to do that. I'm going to change it up a little bit here because if we talk about gold has definitely been in the news as well. There's two really big gold ETFs that our retail traders like to trade. They like to look at the GDX and then they like to look at GLD. Okay.
Yep.
And I always like to make sure that people understand, look at the portfolio first before you get in, because the GDX is actually it's a compilation of mining stocks that have exposure to gold and things of that nature. And then the GLD in itself has just is gold bullion itself. So it's actually tracking the commodity. So if you want a direct or a pseudo direct exposure to gold directly, you would probably want to look at the GLD compared to the GDX, which the GDX is going to be focused on the companies as well. I'm not saying one is better than the other because the GDX was outperforming GLD for a
Yeah,
considerable amount
that's
of
right. It's
time there. So,
apples to oranges. So the gold
right.
exposure was we've owned gold for quite some time, and it's been a slow but steady move higher in gold. But GDXJ is another ETF. So you bring up a great point. If you don't want direct exposure to the price of gold, getting exposure to the miners is important. But if you're looking for even potentially a higher beta on some of the smaller companies, this is the GDXJ, which is the junior miners, and it's been a volatile trade. But at the end of the day, I think diversification inside of the miners, the junior miners, and actually gold itself makes a ton of sense as we still see federal banks globally stimulating the market. So I think gold is going to have the ability to get back above 1,800 in the futures price. and maybe retest that 2012 high of over 1900, but I think it's going to be just a slow inch forward. But gold, we own that in our tactical rotation model. We've owned it since December of 2018, and it's been one of the few asset classes through all this turmoil that's been positive on the year here in 2020.
Definitely, yeah. It's actually been very interesting to see gold as of late. Let's see the futures contract. I believe July is going to be front month, so we're looking at $1,714.90. Saw a little bit of a sell-off with gold the last couple of days, but really that sell-off is just the risk. It's just taking that risk off the table. So you're looking at a sell-off in treasuries, which is why the yields are actually going up higher, and you're also seeing a little bit of a sell-off, not as much, but a little bit of a sell-off in gold. That's also looking at rotating into some of those equity names that are out there we talked about. So, Jeff, I want to quickly, we didn't bring up the NASDAQ. So, the NASDAQ has been the darling of all of the indexes since the sell off here in mid May. NASDAQ right now is at 9,600 at this point. So really, what can we say? We already talked about the COVID trade. So there's a lot of funds moving into technology stocks like Zoom and Salesforce, Workday, obviously, Amazon. But Nasdaq was also being helped out by a couple other names that were out there too, like Tesla, which was very interesting. Tesla saw a really big bid up despite the sell-off, and despite it being actually a consumer discretionary type of stock. What are your thoughts on the overall Nasdaq? Can we continue to see this run up higher, or do you fear that there might be a little bit of a rotation just within the NDX and the Nasdaq in itself?
I think there is a little bit of rotation, but I don't think the NASDAQ, the run is over. Why is that? You continue to see assets be attracted. It's a very focused approach, and you're seeing this global stimulus. It ends up coming back domestically to our NASDAQ. And if you look at the year 2019, Kevin, you remember the S&P 500 last year was up over 30%. There were two tech names that contributed to nearly half of the S&P 500's performance. Over 15% was attributed to two names, Apple and Microsoft. And here we are again this year. We're seeing Microsoft, Apple, but we're also seeing, like, if you pull up XLK, that's an ETF, broad swath ETF we like to use. Very important to understand that the weighting to Microsoft and Apple are about 20% apiece, but you also have Visa in there. You have Intel, MasterCard, NVIDIA, Cisco, Salesforce. So I like having a more diversified approach here. If you've had just a long Apple exposure, just long Microsoft, maybe this is the time to synthetically reduce some of that single stock exposure and more into an ETF. But I don't see why the NASDAQ 100, the run or the attraction of it globally is going to diminish unless there's some bigger headwind, unless there's a second wave of COVID-19. Technically, it has a lot of strength right now, and I think this is going to continue to move higher because a lot of people are in disbelief. It is defying gravity, but that's when markets typically like to squeeze shorts a little bit higher. So I think there could be another 5% move higher in the NASDAQ before it really consolidates and back and fills on this chart we're looking at.
That's very interesting. So we have Rodney is asking, is the NASDAQ, and I'll bring it back up, did the NASDAQ complete a V-shaped recovery? Did it do the impossible? What do you think, Jeff? Would we consider this to be a V-shape?
Pretty impressive. Pretty impressive. And if we put it on a longer timeline, it looks more like a V. But it's interesting. I think Rodney brings up a great point, and it has been a dislocated rally. So this dislocated rally, if you look at the NASDAQ 100, the top 10 names, these are all the darlings that we know, the Microsoft, the Apples, the Amazons. Those top 10 names have really been hitting on all cylinders. But the other 90 names, they're down on average about 8-9% year to date. So you're seeing some dislocation inside the NASDAQ 100, which is the top tech 100 names that we love. So I think it's important to understand where you're exposed. If you've participated in this V-shaped recovery, it's been fantastic. But I think there's an opportunity where you have to understand maybe equal weighting some of your exposure makes a ton of sense at this level because it's only natural for the market to back and fill. It's just a matter of when. And that's the thing that a lot of market participants and a lot of skeptics are trying to understand, but no one's able to really measure with the economy, the way we press pause on the economy, the way we've offset that or attempted to offset that with all the stimulus. maybe there's too much stimulus in the market. No one's really talking about that. I don't believe that. I'm just trying to throw it out there, Kevin. If there's too much
Mhm.
stimulus, maybe the market can move another 5, 10, 50% higher and overheat, which would not be healthy for the stock market. But it is a possibility, it is a scenario as we still measure in June and July, and even to this fall, to what extent the damage, and that'll be relevant in Q2 earnings and really reveal the Q2 earnings. But right now, it doesn't seem like NASDAQ wants to quit. Can't stop, won't stop.
Right. Now, I actually did overlay the NDX. So the NDX is the NASDAQ 100, the top 100 stocks in the NASDAQ composite. And it's just interesting, Jeff, to be able to see this divergence. And it's even diverging even more, where it's gapping between just the 100s and then the rest, right? So the 100s actually they did actually have all-time highs. It hit all-time highs earlier today, I believe. The NASDAQ 100 did. Now, Jeff, you were talking about the potential inflation risk, and we have CPI numbers, but as you know, CPI is a little bit of a laggard indicator compared to maybe what's on the ground. What would you look at as far as an indicator that maybe we're overheating a little bit and maybe inflation is starting to impact the consumer? What would you look at?
We like to look at PMIs. We think GDP is a little bit of a rear view look in the mirror as well, but understanding some of the different inventories, the purchasing manager index, I think those are important to understand moving forward. And I think it's going to be fascinating to see as analysts continue to readjust their forecast of what GDP looks like. And that's just us gathering data, week by week. But Q2 earnings is really going to set the stage. And most of these S&P 500 companies have removed forward guidance. But I think you have to understand sentiment in conjunction with some of these purchasing managers. A lot of the data we know is going to be bad on jobs, on a variety of different points. But the PMIs could be an interesting current snapshot of what's actually going on in the economy, as we really don't understand. I mean, we're in Chicago right now, and it's a very different environment in the state of Illinois than in the state of Texas. It's very different in California than in the state of South Dakota. It's very different in New York than in the state of Florida. So it's really hard to get a true snapshot of what's going on because we've never been here before, Kevin.
No, I agree with you. Yeah, it's a very interesting market that we're seeing here. Jeff, we got a little bit of time left. Want to just do a little bit of a breakdown. Just so we all know, maybe I didn't say before, but maybe I did. Unemployment claims did come in at 1.877 million today versus 1.8 million expected. Continuing claims were at 21.487 million. The prior number for continuing claims is 21.052 million. So we did see a little bit of a buildup. Once we start seeing that continuing claims number start to come down a little bit, I think that you'll probably see another, maybe potential for another rally within the marketplace, because where you will be assuming that the jobs are coming back. As you said earlier, the ECB is boosting its pandemic emergency purchase program, and it plans on spending 1.35 trillion euros in order to stabilize their marketplace. And then when we look at earnings for this week, we have Broadcom. So Broadcom was we had a couple of attendees actually ask about this yesterday, but we have Broadcom, DocuSign, and Slack Technologies, all reporting at the close today. So what we wanted to do real quick here, Jeff, is we want to look at just the anticipated move that the marketplace is expecting for Broadcom. So AVGO. And the way that we are going to do this, as you're familiar with, we'd like to look at the nearest expiring option contracts. And what we can do is actually look at the straddles. So we'll look at the straddles for this week. And obviously the market's getting to the last 15 minutes. So we're going to see the prices move here. But it looks like the at-the-money straddle, if we're looking at the 307.50 calls and puts, looks at a midpoint of 1320, and we're currently trading at $307.16. So it looks like the market's actually pricing in about a 4.2% move for earnings. Really, probably all of that the value there within those options are going to be earnings anticipation, since tomorrow is only the last day to trade those contracts. So that's just one of the earnings moves that are there. And then tomorrow we have Unemployment numbers that are going to be coming out when it comes to the unemployment rate. Now, the market, and I've seen a wide range of estimates, but I've seen estimates as high as 21.5% and as low as 19.5%. So I think that's going to be very anticipated. Then non-farm private payrolls. We have a briefing estimate of a negative 11.5 million. So 11.5 million jobs lost is the estimate for non-private payrolls. I'm actually going to be
That's
interested to
important, though.
see.
I think that's
Yeah,
important, that expectation, because last month it was pretty perplexing to a lot of us managing money when we saw the expectations of the actual jobs lost. It came in better by a million, but it was still 21.5 million to the negative side, and the market actually received it well, and we saw a small rally. So I think I'll be really curious to see the unemployment rate that you spoke of, but the actual numbers itself and how the market responds to that, because again, I think we are bracing for the worst, and I think this is a different type um, of course, this is a different type of jobs data number. We're actually seeing something that we've never seen before, but I think it's the market saying that we're going to have this quick V recovery. We're going to see people back to work. And now we're trying to measure what the actual damage is to the economy. So there's just a lot going on right now. But tomorrow it could be interesting to see if the market takes a little bit of a breather after it's just been up, and away, specifically in some of these tech names.
definitely. Definitely, Jeff, we are going to wrap it up there. Any last words, any other things, other items that you're looking at as far as the overall marketplace?
I think you have to understand the breadth of the market. I think it's important to understand when you have not a day like today, but when you see these rallies, which sectors are actually participating and get a better understanding if it's a broader participation. Because if it's just single stocks and if it's just single sectors, I think that promotes the opportunity to back and fill, and it's not sustainable. But since we've seen the last couple of weeks, we've seen some of the laggards, some of the industrial sectors participate. I have a little bit more bullishness and a little more perspective going into the month of June because of the broader participation. That really wasn't the case in the month of April or the end of March. So now we're seeing a little bit more broader. So this gives me a little bit more hope, even though we're above 3,000, which is, it's kind of the line in the sand here, S&P 500 wise.
Yeah, we have. I'm going to be curious to see what the numbers are going to be looking like tomorrow. I'm curious to see once we get into July, some of the June numbers that are there to see if the stimulus measures that were put in place by the Fed and by the Congress and the United States and the White House to see if those are going to be obviously they're going to be impactful, but how impactful they are going to be and how effective
For
they are going to
sure.
be. But overall, Jeff, it's always a pleasure to have you here. Thank you so much.
Hey, Kevin, great being here. Thanks for having me. We'll talk soon, my friend.
Definitely stay safe. And to those that have joined us today, join us up next for introduction to futures trading with derivatives trading manager Katie Johnson and regional investment strategist Craig Porzinski. And if you have any questions, please feel free to submit them below. We want to make that as interactive as possible. For everybody that's joined us today, please, stay safe out there and good luck with your trades. Thank you for watching. Have a nice day.
So Schwab just taught me about an iron butterfly spread.
Nice. I just tried an iron condor.
Only spread I've been introduced to is this onion chive.
It's time to trade up to Schwab, the firm invested in helping you become a better trader.
Hi, it's Jeff Kleintop with 90 seconds on what we're watching this week. Social distancing has replaced stay-at-home rules as reopenings extend to some casinos and zoos and parks and beaches. Our weekly real-time recovery heat maps have shown steady progress as many national and state economies were restarted in May. Data released in June for the month of May should reflect some improvement, and if improving economic data continues to support fresh market leadership by cyclical stocks as it has in the last couple of weeks, that could extend the rally. Now, Friday's jobs report for May has economists expecting a smaller loss of 8 million jobs following the loss of 20 million in April, but the unemployment rate is expected to increase to 20%, which makes it the highest in 85 years and hopefully the peak. U.S.-China relations continue to be tense, and Hong Kong protests could heat up, especially with Thursday marking the anniversary of the 1989 Tiananmen Square protests. But the